Imagine waking up every morning knowing you have an 88% likelihood of predicting the market's direction. That's the claim behind this trader's daily bias strategy, one that earned him over $111,000 in 1 week. But is this something the average trader can actually pull off? Let's put his strategy under the microscope and find out.
I just closed out my trading week with $111,000 in profit using mainly daily bias. It's a systematic process that's been the backbone of my 7-figure trading career. In this video, I'm breaking down exactly how I executed these trades and how you can apply these same principles in your own trading. So grab your notebooks and let's get into it. All right, let's talk daily bias. So in this video, I'm going to walk you guys through step by step how I actually determine daily bias and how I implement it in all of my trades. So at the end of this video, I'm going to walk you guys through 5 of the trades that I took this week that allowed me to make $111,000.
Okay, so 111K in 1 week. We got the whole thing mapped out, starting with what is the daily bias strategy. And it starts with identifying market structure involving recognizing higher highs and lows versus lower highs and lows. Okay, so this is trading price action 101. You got to start with the fundamentals here.
So first of all, what we need to ask ourselves is the market making higher highs or higher lows, or lower highs and lower lows? So all we need to ask ourselves is when we're looking at our daily time frame, and I'll do this at the end of every daily candle closure. So in the afternoon, 6 p.m., 7 p.m. Eastern time, I'll sit down and just quickly flip through all of my daily candles. And all I'm looking for is, did that prior day or did the day that just closed, did we create higher lows and higher highs? You guys can very clearly see here that we did. So yes, created a higher high as well as created a higher low. So I know that day to day, right, today closed strong. And vice versa, if I'm bearish, right, did the market create lower highs and lower lows? So you guys can see here that this market is weak because this day that just closed created a lower low and a lower high. Now, this doesn't really matter if this candle closes bullish or bearish. That's really not important. Just look at the highs and the lows of the prior day.
Okay, so we've got bearish versus bullish, and he's starting with the daily chart. Let's look at the daily chart right now. Okay, here's the daily chart right now. Now tell me if you see what you see on the daily chart. The daily chart is here on the left. Okay, daily chart's right here on the left. So tell me in the comments right now so I can make sure that you are here to learn something. Show me that you're paying attention. You're not just here to be entertained, because the goal with this video is to have you learn something from this video and take it and apply it to your trading so you can get some more of this. So to do that, you've got to actually pay attention and process, internalize, take something away from what you're learning. So is this a bearish daily bias or a bullish daily bias? What do you see right here? This is today and this is yesterday. Okay, this is today, this is yesterday. Tell me, bullish or bearish? What do you see? Simple. I'm making this very easy for you guys.
Right, just ignore the bodies of the candles. That to me is not as important as looking at, the actual structure of the market. Are we creating higher, lower highs and lower lows? And if we are, does that align with the direction that I'm trying to go?
Awesome. And my man scrolling got it. Yes, the answer is bearish. Nice work. Let's keep it going.
Okay, so that's the first question I'm going to ask myself. The second question that I ask myself is, if it doesn't do that, right, did the market recently reject a previous daily high or low? And that's going to give us what? Pin bars or outside bars. So when I'm looking at, 2 candles, again, when it comes to my daily bias, I'm not trying to go so far back into price data because I really don't care what happened months ago. All right, I don't really care what happened even a couple weeks ago. All I care about is what happened the past couple days, because that's really current order flow. I'm trying to trade current order flow, and if it respects some of those levels that occurred from prior months, then it makes sense. All right, but really, I'm trying to be present in the moment, and I'm trying to trade what's in front of me. Right.
Okay, awesome. So we're just looking at the last few days, right? The last 1, 2, maybe last 3 days. And you've got that we have to start by identifying whether we've got higher highs or lower lows, right? Bearish or bullish. Higher highs is going to make bullish. Lower lows is going to make bearish, right? Now, the candlestick pattern includes engulfing bars, pin bars, and inside bars. He's going to explain that next. And then we're going to get into a discussion on liquidity and key levels. But before we go any further, I want to make sure that you understand what the daily buy strategy is in essence, because essentially you have to understand the strategy and the basics of what the idea is. Okay. So with the daily buy strategy, what we're trying to do is use the daily chart. And we're not going to use the daily chart to place our trade, but we're going to use the daily chart to get a sense of what direction the market is heading. So right now on the S&P 500 E-minis, we can see, as my man scrolling told us, we are what? Bearish. Okay. So that's going to tell us the direction. Think about the ocean. We're trying to see where the tide is moving. Is the tide moving in or is the tide moving out? And why are we doing this? We're doing this for one reason and one reason only, because we want to go with the tide. We don't want to go against the tide. We want to go with the tide. So we start by understanding what direction the tide is moving. In this case, it's going out. Right? So that means we're going down. And then next, we're going to look at some strategies for how to actually find a trade that moves in that overall direction of the market. And I just want to tell you, if you're new to trading, this is one of the best ways to start. You start by only trading with the trend. Why? Because trading with the trend is the highest probability thing that you can do, because you have the highest likelihood of getting the direction right and winning that trade if you go with the direction of the trend instead of trying to go against it. It's like life. Better to go with the flow instead of fighting against the flow of life. You can, and sometimes it's important too, but more often than not, if you go with the flow of the ocean, if you go with the flow of the wind, if you're sailing in a sailboat, you got to get with the wind and sail in the direction. That's how it works, right? Same with the ocean, same with the wind, same with trading. Let's keep going.
Right now. So we have our previous day's high, and we have a clear rejection and a closure back inside the range. Okay, that's one indication that the market is possibly bearish. On the other hand, right, if we fail to break below the low and close back here, right, we're failing at this previous day's low. All right, so these are two pin bar examples. So day to day, if this market closed like this the prior day, the following day, I might be leaning bearish as long as I have a drawn liquidity below us. Or we might get engulfing candles. So here is where, I've talked about this before, but really these setups are market maker sell models and market maker buy models as taught by ICT. So really, the indication is that we've taken out the previous day's high, but we've also taken out the previous day's low. Now, it is important where this candle closes, because if this candle closes bearish, right, now this becomes a bearish engulfing candle, right? Because we've completely engulfed the previous candle. Now, this candle here could be bullish or bearish. To me, it doesn't matter again. I'm just looking to see that we took out the previous day's high and the low. All right, and a strong closure towards the lows, again, important. Now, previous day's low, previous day's high. This is a bullish engulfing candle, right? So typically you'll run out the previous day's low first, come up, create a high, and then close here. So we'll run out both sides. So we'll run out the low and the high, but it's going to close near the highs. All right, that's our bullish engulfing candle. Okay, so these two candles can also give me an indication of where the market's going to go that following day. The third question that I ask myself, right, if I don't get any of those setups that I just mentioned, is the market indecisive? And now this is inside bars. So when we have an inside bar, it really just means that we've failed to take the previous day's high or low. Okay, because if this wick's lower, that's not an inside bar, right? The high and the low of this next candle needs to be inside of the previous one. Now that to me means what? Just from a standard market perspective, that just means that there's, the bulls and the bears are pretty much even. There's consolidation. They don't know which direction the market's going to go. Okay, they're battling. And then that next candle, maybe if we get a break out of that inside bar, then we can assume that the market's going to go higher or lower, right? Because now we're going from what? This candle right here is giving us consolidation, right? This one single candle will tell you if the market's consolidating. That's all I need to know. Then, does the market have PD arrays? So fair value gaps, breakers, mitigations, equal highs and lows above or below the previous day's high or low. So if I have a fair value gap that's below a previous day's low, maybe I don't want to go long yet. Maybe I want to wait for this market to possibly trade down into that level and then go long. but my bias is still bullish. It's just not as bullish because we have an inefficiency. So when we have these inefficiencies and these PD arrays below and above us, it makes trading a little bit more difficult because let's say if you entered and then the market actually goes down there, taps that level, and then goes higher, right? It makes the setup a little bit more risky if we haven't reached those levels. So again, unvisited PD arrays. Now, is there a clear draw on liquidity? Okay, so after I've done my candlestick analysis, which is very plain and simple, I'm only looking at the last couple candles. Is there a clear draw on liquidity? Okay, so once I get that candlestick formation, whether it's a pin bar, whether it's an engulfing candle, whether it's an inside bar breakout, is there an actual clear draw that I can target once that setup appears? And that's in the form of what? Either I'm going to target equal highs or equal lows. So there might be a level of equal highs or equal lows. Honestly, it could just can be as simple as a previous day's high or low. So it could just be a single candle's high or low that you're targeting. Not only that, but we can also possibly have inefficiencies that we're going to target. So let's say if this market's been bearish, but we're starting to get some indication that it's turning around. Is there an inefficiency that's above us that we can possibly target, right? Or if the market's been bullish and it's leaving behind all these inefficiencies and this market starts to turn around and start doing market structure shifts, and now this fair value gap is resting at a discount, right? Do I want to counter trend, trade that down to that specific inefficiency?
Okay, great. So just to review, we've got what the daily bias strategy is. And the question is, does this strategy actually work? Okay, so let's look at some pros and cons. First, we've got the strategy offers a systematic approach that enhances your outcomes. Why? Because as I just mentioned, if you find out the direction that the ocean is flowing and you go with the flow, then you're more likely to win the trade. Simple. Go with the flow usually results in better outcomes, okay? This approach focuses on all of these indicators, right, that he's pointing out for us. And it allows you to make decisions that are timely because you start with the daily chart, you get the daily bias, and then you have time to wait for the right setup. So it gives you a simple decision-making process that a trader can follow easily. And your trading is up to you. But I'll tell you right now, if your trading strategy is overly complicated, you're less likely to be able to execute it well. So generally speaking, the simpler the strategy, the more successful you're going to be because the easier it is to execute.
Okay, so when I'm looking for a draw on liquidity, it's very simple. Either I'm targeting highs or lows or inefficiencies inside of the range. So that was just a quick step-by-step process. Now, before I walk you through the exact trades, if you need access to the above process, check the link in the description and I'll share this mirror board with you. That was plotting out the most interesting levels that are right in front.
Okay, so those are the pros. Let's look at the cons. One, execution is key to the success of this strategy. So this strategy requires executing well, and you have to be able to execute well. Otherwise, you're not going to do well with the strategy. Cons. The strategy does not guarantee 100% win rate. However, it has a high probability of success. There is no strategy that guarantees 100% win rate. So this strategy doesn't guarantee it, and no strategy guarantees it. And furthermore, you don't care. You are a smart trader because you know that you don't care about the win rate. You care about the average profit per trade because you know that you can have a 99% win rate and still be losing money. So it's not about the win rate. It's about your win rate times your average win times your average loss. That's your average profit per trade. Now, the third con is that it requires discipline and thorough back testing because you have to know that not only does the strategy work, but you have to do the back testing and do the research so that your brain sees the data and it knows that it's something it can count on. So those are the pros and cons. Now let's get to the trade recaps. He's got 5. He's going to break down for us. So let's start with trade 1 on Monday.
In front of me. So we did trade down to this bullish fair value gap, but we also have this bearish fair value gap above us. And the weekly time frame was quite bearish. So what I'm looking for is a possible run down into what? This volume imbalance. Now this volume imbalance is also termed as new day opening gap. So really, this is all I'm looking for. I'm looking to see if this market is going to respect this daily fair value gap. Now, I'm going to drop down to the 4-hour time frame because this is basically the time frame that I used.
Okay, so follow him along here. He started with the daily time frame. Now he's going down to the 4-hour time frame. They call this top-down analysis. Very typical with the daily bias strategy.
To place this trade, and I'm just going to quickly walk you through the thought process here. So not only do we have that daily fair value gap, right? So when I get down to my lower time frames, we also have a 4-hour fair value gap. So when I sat down in front of the charts, I'm plotting this out, right? And recognizing that this market.
And why is this a gap? Why is this a gap? He's calling this a gap. Now, why is that? Because the price broke down here, right? Follow me. The price broke down here. And then what happened after that? We went up to test that gap. And look, the price got rejected down. So that kept a gap open here. Then every time we got into this area, look, went into this area, rejected. Went back into that area again, rejected. Went back into that area again, rejected. Went back into that area again and rejected. So when that happens, that leaves an open gap, which is an indicator that there are more sellers than buyers here.
Market is in a bit of consolidation. So, coming to the charts, this is Friday. Let's just kind of play through price action very slowly. Now, this is Monday.
Why though? Why are there more sellers than buyers here? Because every time we moved into that area, the bears were like, this is bear territory. We're defending this area. You are not coming into this area. And we can see that they were able to defend that area. So that's what a gap means. Think of a gap as territory that one side has taken and defended.
Monday morning. So as we're trading higher, I'm noticing what? We're trading up into all these fair value gaps that I have plotted on the higher time frame. So we have this daily fair value gap, I have the 4-hour fair value gap, and my draw on liquidity is down here. So typically what I like to do is either plot an eyeball or a magnet, either one. That way I know that I'm only trying to trade in one direction. Okay, the fact that we have this bullish fair value gap here, I don't plot these levels. So when I have a very strong bias, I'm avoiding anything that would tell me the market might be bullish. So it's not only doing one of two things. It's allowing you to be a lot more confident in your trade setups, right? Because you're not going to get faked out as it trades down into that level, but you actually want to see that level fail and it trade lower. So as it's trading up into this level, right? Now I'm looking at what? The 4-hour closure. So this is actually our 4-hour closure, right? And this candle closes at what? 10 a.m. Now, if you guys study ICT at all, right? He talks about macros. To me, the macro is just the rollover for the next 4-hour candle. Okay, so I ended up going short, and I'll show you guys, the messages that I was sending inside of my Discord. But really, I was aiming for the sell side liquidity down here. Now, when I looked at all these bodies of these candles, all right, that was pretty much my draw. Unfortunately, I didn't hold the trade to these lows because it was Monday. Just keep note, right? You guys can look down here. It's Monday, March 3rd. And all I really wanted to see was this 4-hour closure.
Okay, so that's trade number one. As you can see, he started with the daily chart and then moved to the 4-hour. Now, this was shorting based on that fair value gap. It's a simple strategy. As I explained to you, we can mark out these gaps by looking at the breakout point, because we can see that, look, the low is here previously. Guys, look very closely at where the cursor is. This is where the prior low was, right? Now, as soon as this candle broke out here and closed on its low, we now broke out below this area. So what does that mean about here, right here, where my cursor is? It means that where I'm pointing right now is the point where the price broke out. This is called the breakout point, right? So when the market breaks out past a certain point, the market will often come back to that point to test the breakout point. This is what's happening right now on the daily chart. If we actually look at the daily chart, we can see that the breakout point was here previously, okay? The breakout point was here previously, right? And we broke out below that point, and then look what happened. Okay, so this was the low. We broke below that low. This candle broke below this low. So now the low is here. And look what happened on the next candle. We went down and then we went back up to test that breakout point. So that's what's happening on the daily time frame. And it happens on a 4-hour time frame as well. So whenever you see a breakout point, and you could also call this a gap, okay? A gap or a breakout point, same thing. Now, we're coming into this gap, and he's seeing that every time we moved into this gap, the bears were able to defend this area, showing strong selling bearishness. And then he's looking to get short here because that is his daily bias.
Let's see what we get on the next 4-hour candle. Boom.
And there it is. Okay. So again, the bulls tried to test the bears and move into bear territory. And again, the bears were like, hell no, this is bear territory. Okay. And look at this insane move down. Okay. As soon as we got into this area previously, we shot the price down and we shot the price down. And then look at this. The bulls were able to make some more gains into that bear territory. Look how much higher we got on this one versus this one or this one. So we're encroaching into that bear territory, and it's like a rubber band. The more we pull, the more it snaps back. So that's what happened here. And we're looking for some indicator that the bulls are losing momentum. And this was that indicator right here. And then we moved down very sharply, and he got short somewhere in here.
Straight to the liquidity that we were thinking about. All right, and as is drawing to this liquidity as well. And do you see what I mean by your daily bias? Right, that daily bias is much more important than what you're seeing on this lower time frame. Okay, because the daily time frame, now look what the daily is doing. This is actually a daily. So if I just go back one bar, this is how Monday closed. And this was just one trade, okay? So it's very clearly, all right, bearish because we didn't violate this bearish fair value gap. You guys can see how many times it's traded into that level. And then as we were trading up here, right, I'm just looking at this 4-hour fair value gap, us running out all this buy side liquidity, right? This all aligns with the daily bias that I have in place. Okay, so when I sat down on the charts on Sunday night, my daily bias was bearish. This, just a very quick trade. Now let me hop over into the actual trade execution. So you guys can see here at 9:13, right, before that 4-hour candle closure, I'm looking at YM today to see if we respect weekly and 4-hour bearish fair value gaps. There was a daily bearish fair value gap, but this is just, you know, kind of the overview of that daily bias. So I ended up shorting YM, right, at 9:57. So if we go back to our charts here, 9:57, pretty much right before this candle closed here. So this specific candle here, and I entered it right before it actually closed, just because I was quite confident that we were going to get a strong close here. My stop loss was up here, and I was really looking kind of for just like a 1-to-1 inside of this bullish fair value gap. So this is kind of when I'm using my lower time frames. You guys can see here, I was mostly paying attention to that 4-hour fair value gap. I have my Asian range standard deviations in here. And what I'm looking at is possibly a market structure shift. We've got a volume imbalance in here, and that's kind of when I entered, all right? So I shorted YM here. At 10:45, I moved my stop to 44,118, which was, I believe here. I moved my stop just a tad, and then I added in and I adjusted the stops again at 11:08. So as this market was breaking down, I adjusted my stops pretty much to break even. Okay, so more risk taken off, closed in full at 11:36 a.m. So I closed in full here, right? But if I actually go back and look at our charts, I closed in full here, but this market ended up trading higher and then just completely collapsed. So, I mean, it's totally okay. When I'm sitting down to journal at the end of the day, the only thing I really care about is, did I have a bias for that following day, and did I follow the bias? That's all I care about. This example here, I follow the bias perfectly, all right? So, at the end of that day, ended the day with a little bit over 1R, so I'm typically risking $1,000 on these accounts because I have such a huge buffer. So I got 1.4R out of that because I added in and adjusted the stops. So I had 186,600, and then at the end of this day, also, my payout request got approved. So my new balance at the end of the day is going to end up being 183,850. Now I'm walking you guys through this because one of the P&L screenshots, I did not include the excess intraday on the right-hand side, which is the trade that we're going to go through right now. Okay, now sitting.
So that was trade 1. Okay, so now let's get to trade 2 Tuesday. This is going to be a bearish bias confirmed, resulting in that liquidity grab or sweep.
Down Monday night, this is the candlestick that we have. You guys can very clearly see that we're breaking through a lot of these levels. And when I look at this previous daily low, right, we're not getting a rejection from that level. So my eyes kind of go towards what? These next lows down here, all right? So down here and down here as well. So these levels down here really are my downside targets. Now, unlike the first trade, I actually was able to record this next trade. So let's get into the actual trade recap. So you guys can see here that this is the 4th of March, and really what I was looking at was this hourly fair value gap, okay? So when I sat down in front of my screens, I was looking at that hourly fair value gap. Now I was flipping through some other markets to kind of share with my group, but I ended up going short here. You guys can see based on, you know, that hourly candle, I was expecting that we had already seen a retest into that hourly fair value gap, and then we would trade lower. Again, this is all based on that daily bias. All right, so I have this red shaded area is my hourly fair value gap. Now, I believe we had news at 10 a.m. So we'll just keep watching. I gave myself a little bit more breathing room there. You guys can see I moved my stop just a little bit, but now I adjusted my stop a little bit lower and added another contract. So that's based on what? this 5-minute inverted fair value gap, right? That next 5-minute candle, we ran out that buy side liquidity there, and then we got a nice closure. So really, I had confidence to add into the trade, right? Because I didn't put on full size right away. I only put on 2 micro contracts, right? So it wasn't a whole lot of risk. So I added another 2 micro contracts, which got me up to my full size position. And then not only that, I had my stop lower than where I initially had set it. So let's keep scrubbing forward. So this market actually took me out of the trade. So I actually got stopped out of the trade because I think I overmanaged the trade. You guys can see that that 5-minute candle went above that high one more time and then came back down and closed. Now you guys can see here, there's still 10 minutes to go on this hourly candle. Well, my daily bias is still bearish, right?
Okay, I want to point something out to you guys. Do you see this candle here? If this is an hourly candle, okay, I want to point something out to you guys that will help you if you're interested in trading daily bias. Now, on a 5-minute time frame or a shorter time frame, you're going to see things that are very different than what you see on a higher time frame, like a daily chart, okay? If a candle is daily, that means it's hours for that candle to close. And what you can see on this candle, I want you to look here and see, do you see this giant tail on the top of this candle and the giant tail on the bottom of this candle? That means that the market is in a trading range, okay? So if we are in a trading range, then that means there's buying and selling, and the market is pretty much balanced. You've got two-sided trading, which means buyers are participating and sellers are participating. And yes, the market is biased bearish, right? We're heading down. We can see that clearly by this giant candle closing on its low. This is a bear close. And it's also a bear breakout because this candle broke below all of the lows to the left, okay? So yes, we are bearish technically. But after that, we stopped here. We paused, right? Because the day closed here, and then the next day closed right there. So we're kind of going sideways. And then the next day, we went up and we went down and we went up and we went down. And we're just kind of going back and forth. So when the market is in a trading range like this, and the simplest way to tell is just if there's a big tail on the bottom and the top, that's a doji candle, then it's not the best idea to use a tight stop. And what he's saying is he was managing the trade a lot and he was, adjusting his stop. But the problem is you will often, because the price is going back and forth, the price will often come and move into an area where the price was before and then get sucked back down into the middle of the range. So it's better to use wide stops if the market is doing this. If the market is in a trading range, you're better off using a wide stop and sizing down so that you don't get taken out and then immediately see the market go your way.
I lost a small amount on that specific trade. My bias is still bearish. The 5-minute candle just gave me another confirmation. So what I added another position. So
this is what a trading range looks like on a daily chart. This, if you look very closely right here, this is what it looks like on a shorter time frame. Lots of tails on the bottoms and the top of the candles, and all the candles are very smushed together and there's a lot of overlap.
Went back into the market after taking that initial loss. Because why? This 1-hour fair value gap is still being respected.
Okay, what I'm saying is if you want to avoid having to take that initial loss, you can size down and use a wider stop loss.
Okay, and there's still 9 minutes and 39 seconds to go. So after seeing that manipulation one more time, I had ultimate confidence because this is all based on my higher time frame analysis. Right? So when I'm sitting down to do my high time frame analysis, that bias is carrying through all my decision making the following day. I'm not coming down and seeing bullish setups and trying to go long when I was bearish when I sat down the night before. Okay, when everything lines up, when my low time frame aligns with my high time frame, that's when I go into the market. When it doesn't align, I sit still. Now you guys can see here, I added into the trade again.
Okay, so let's just underline that. Here's the next step and the next key to the daily bias strategy. As we can see, we start with understanding and identifying what is the daily bias. Is the daily chart going up or going down? Just looking at the last 2 or 3 candles, right? So for today, for example, we noted that we're clearly moving down because we've got lower lows and the highs are also getting lower, making a bear trend. So look on your chart and see on the daily chart whether or not we're moving lower or higher, right? That's step one. Now, the second thing we want to look for is we want to look for an alignment from the daily chart and the shorter time frame. Maybe it's a 5-minute chart. I like trading the 5-minute chart. So if I'm looking at the 5-minute chart, then I want what's happening on the 5-minute chart to align with what is happening on the daily chart. So if the daily chart's biased, if the daily chart is biased, bearish, then we're going to look for a bearish setup on a shorter time frame. Simple enough, right?
Adjusted my stops and my limits, and now I have a full size position on again. So at this moment, I was down, I believe, roughly 0.75 R on my total daily risk limit. So I was okay risking 2 R on the specific setup, on the specific day, actually, because I had such strong confidence that we were going to respect this hourly fair value gap and this market would trade lower. All right, you guys can see there, it tapped up into that daily inverted fair value gap again. I adjusted my stop to a little bit above that 5-minute inverted fair value gap. Okay, now we're coming up on what? The hourly close. Look how strong this hourly close is. And this is just a 5-minute time frame. Now, after this hourly close, right, I'm totally fine just holding this position.
Yeah, and as an alternative, and obviously hindsight is 20/20, but as an alternative, instead of entering way up here, you could wait for an actual breakout of this range and then enter short here. This is a strong breakout in an overall bearish market. So now you've got a bear breakout in a bear trend. And so if you entered here, you would have taken no drawdown and the market would have gone straight down. So that's an alternative.
And as you guys can see, this is up, 471 ticks right now. So I end up closing as we were approaching that previous daily low. So I have my previous daily low. Let me just scrub forward. You guys see there? I had my previous daily low, which is very quick. So that's really the level that's down here that I'm targeting. I'm targeting that old previous daily low. And then we have another a large 1 minute fair value gap that I was looking at. All right, and I move my stop down again. You guys can see that I move my stop down again. And sorry, I'm flipping between all these different markets. My students get to see me analyze different markets live. All right, so as this market's
Vishal, thank you.
Trading lower and lower, I'm adjusting my stops with the expectation that we should start tracking towards this previous day's low. So I just closed half the position. All right, so I went from 4 contracts to 2 contracts. Now my stop is in profit. Okay, so if it comes back on me and stops me out, I'm in profit still. So this trade is up 800 ticks at the moment. And I just exited in full there. All right. So that was trade 2. You guys can see here, this is a screenshot of those executions, right? All based off that daily time frame though. Okay, so if I go back to this daily time frame, this is really the daily that I was looking for. The next day, right? What did it give us? It gave us that, right? As we were trading towards.
All right, so we've got trade 1, trade 2. Now let's get to trade 3, where he took a loss, okay? And he took a loss due to a market shift. So let's see what happened there.
That previous day's low. That's pretty much where I exited. And I exited pretty much at the low of the day because we never took out that previous day. So on that specific trade, I made about $1,500, my new balance, and I'm just only talking about Apex right now because a lot of these are challenge accounts. That new balance is $185,000, 381. All right, so trade number 3, this was Wednesday, the 5th. You guys can see here that we rejected this daily fair value gap, traded through this volume balance, and we closed.
Again, like I pointed out to you guys, the low is here, right? This candle broke out below that low. That means the breakout point's right here. And notice after that happened, after this candle closed down here, breaking out of this low, we went back up to test that area, right? We tested that area, we tested that area, we tested that area all the way until we tested that actual breakout point, right? Now, this is why I like breakout points better than fair value gaps, because the breakout point is actually, notice what happens when we test the gap. Well, we actually get rejected out of that gap and move down. But notice what happens when we actually test the point of the breakout itself, a little more precise than a fair value gap. The point of the breakout is right here. And notice that as soon as we actually breached that breakout point by just a few ticks, notice this candle, the tail on this candle, only went a few ticks above that breakout point, then we got the strong move down, okay? So whether you're using fair value gaps or you're using breakout points, I don't really care. But I just want to point out to you that if you are able to not only identify the fair value gap, but also be even more precise and identify the actual breakout point, which is right here, that can make your entry even more precise instead of just guessing about a kind of vague, wider area. You can get the actual point within a few ticks, which allows you to actually enter a trade with less risk and way more profit potential.
Very strongly through the previous day's low, which was Monday. So not only are we creating lower highs and lower lows, it's doing so in a meaningful manner. Like, we're not just getting a very shallow close below that low. It's really pushed through that level. So coming into Wednesday, right, I had the same bias in mind. So this was the 4-hour fair value gap that I was watching. And then if we drop down to 1 hour, we had another 1 hour fair value gap. As you guys can see here, this is the live execution. Once again, I was looking for, that run lower in YM. We had another smaller 1 hour fair value gap that printed here. So that's really where my stop was. You guys can see that I aggressively move my stop as it goes in my favor. Even if it's a little bit, if I have a level that I can trust, which was that hourly fair value gap, that newly printed hourly fair value gap, I don't mind putting the stop there. So I put
You got it, Vishal. I'm never stopping.
my stop at the high of that specific candle. Now, I believe this market was starting to show signs of life because, as you guys can see, there was 8 minutes and 32 seconds to go on the hourly candle. So even though I entered and it went straight against me, I didn't really mind because there was still 8 minutes to go on that hourly candle. And as you guys can see, if we just scrub forward a little bit, you'll see that the hourly did close, in profit. So even though it went up there, pretty much straight away after I entered, it was still respecting this hourly fair value gap. The problem was that there was news out at 10 a.m. So I'd still, had my stop in a logical area. I thought that at the close of this hourly candle that this thing was really going to just run lower. Okay, because we also had SMT. So, that's something that you guys can also study. So there, I had gotten stopped out just very quickly on the news candle. And let me see if I could pull it up. Just happened extremely quickly. So there's the news. News just came out. Boom, got stopped out.
Okay, and that's why you shouldn't trade into news, okay? What should you do instead? You should go to a website called financialjuice.com. Financialjuice.com, and it'll tell you what news is coming out, whether it's the Fed changing interest rates or the consumer price index. There's certain news updates from the federal government that will completely affect the markets. So, and what's a really bad idea? One of the best things you can do from someone who made $111,000 in 1 week is learn from their success. But even smarter, learn from their failures, okay? So if you learn from someone else's failures, like a trader doing something that really screwed them up, you can save yourself possibly from making the same mistake. So just don't trade into those news moments and stay out of the market until it happens and you see how it affects the market. Then you can get in there and start trading.
Now, I took another position, short, after getting stomped out and put my...
See, that's better, right? You see what happens after you see the effect of the news, then you start to jump in there and trade.
Stop, at a level that I thought made sense. Because we were still respecting that fair value gap, all these fair value gaps, and not only that, but if we take a look at the hourly opening price, typically when you get news candles that print that don't put a lower wick in, it's usually an indication that the market's going to go lower. And I adjusted my stops all the way down to pretty much this candle's opening price, this candle's closing price. And then I ended the stream because, I wasn't going to sit on the stream all day long. The market was already moving pretty slowly. And you guys can see here that I had already been streaming for 2 hours. So unfortunately, that trade turned around on me and came all the way back. So if we take a look at, that specific trade on the 5th, if we just scrub forward, right? This is that price section I was talking about. It's fair value gaps. It came down, hit this level, right? So it hit the pre-market low. And then the next candle took me out at pretty much break even. So the way that last hourly candle closed, it wasn't meant to be. So that was really a losing day. That day ended up being a loser of $861. All right, so you guys can see that I did move my stops down, and I said this hourly isn't looking good, and that was at 12 p.m. Pretty much right when that hourly candle formed. Right, so right at 12 p.m. this candle here, right, ended up being a pin bar. And I said this hourly candle does not look good. My stop was 42,260, I believe. So I got stopped out of that trade.
Why? Because this is a trading range. This is consolidation. This is what the price action traders call ranging, right? It's trading range. And what happens in a trading range? Buyers buy at the bottom and sellers sell at the top. So the price in a trading range gets near that low and either breaks below it or gets close to it and then gets sucked back into the middle of the range. In a trading range, the price spends about 80% of the time in the middle of the range. If you were to count up all of these candles, you would see that most of the trading happened in the middle, okay? So if your price target is like down here, it's probably not going to get hit. Although if you're betting on a bear breakout, that's not a bad strategy. However, we haven't had a breakout until you actually see the price break out below this low, okay? So yes, the price is breaking out below these lows, but until we break below this low, we haven't actually broken out below this range, and the likelihood and the probability of the price reversing and getting sucked back into that middle of the range is higher.
For another small loss. And the way that market was moving in particular, because I had such a bearish bias and I don't like to flip bias, I pretty much just called it a day. So I gave back half of the profits from the prior day, right? I made $1,500. I gave back $860, a little bit more than half. So my new end of day balance was $184,520.
Okay, so I want to underline something he did really good there, because all we've been doing this video is talking about price action. We haven't been talking about the human being that is executing the price action, as in you. And what does that human being that is executing that trading strategy have? Thoughts and emotions. Thoughts and emotions. So you need to be able to manage your thoughts and emotions well, otherwise your trading strategy will go to shit. And what did he do? He knew when to get out. Okay, this is not something that beginners do well. This is something that the experts do very well. They know how to get out and they know when to call it a day. And he did that, and he did that well. So if you're new, or even if you're not, that's something you want to be practicing. It's called discipline, and it's something every single trader has to be working on. I don't care how good you are.
All right, now let's get into trade number 4, which was Thursday. Now you guys...
All right, trade number 4. So we went 1, 2, 3, 4. Now we're going to look at trade 4, which was Thursday for him, a high conviction short that was executed with sizing adjusted for profit. So let's see.
You can see that when I'm labeling them as trades, typically I'll give myself multiple executions. So my trade idea is just one idea. So each day I have one idea, and I'm possibly giving myself 1 to 2 attempts at that specific idea. Very rarely do I have an idea and I go the opposite direction. Okay, that is an indication that I'm not following my plan. My plan is in place the prior day. So coming into Thursday,
very cool.
Right, I sit down on my chart, Wednesday night, and I see that this candle on Wednesday printed an inside bar. So I am very, very cautious going into that next day. Now let's actually get into why I took a trade that next day. So in the morning session, there really wasn't anything that I was looking for. Right, this market at the time was very much sloppy. I didn't have too many levels that I was looking at. You know, if I looked at this market, we had this 4-hour fair value gap, but that's about it. So we have the 4-hour fair value gap, but the problem is we had equal highs above us. So we have low resistance liquidity on both sides of us. We've got these equal highs, and then we have these lows down in here, which are low resistance. So coming into the AM session, I didn't really have a trade idea. So we can fast forward through all this price action, right? We have a bullish fair value gap here, approaching the previous day's low. Now this is really when I started looking at the charts. Okay, this candle right here, and I would say even the candle before that. So this candle right here, this is leading up into what? Lunchtime. So lunchtime, if I didn't have it set up in the AM session, now I'm looking at new levels in the PM session. So I have an hourly fair value gap as well as an inverted fair value gap. So as I scrub this forward on this next candle is really the reason I'm going short, because it's giving me such a strong indication that we're rejecting all of these levels. We're rejecting...
Yeah, I mean, if you look at this candle, which is a bull bar closing on its high, very strong, right? And then you see what happens next. This is like call, answer. The bull said, hey, we're gonna call bullish. We're coming into your territory, bears. And then the bears were like, oh, no, you're not. And look what happened with this candle. Look at this candle on the right versus the candle on the left. We went up into this territory. Now, this is the biggest bull bar in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, probably 20 candles, right? Since this guy. And look what happened. The bears smacked the hell out of the bulls. The bears were like, hell no, right? And look how much stronger this bear bar is than this bull bar. So that shows you that even down here, and look at where we are, we're like towards the bottom of the chart, right? We're not up here, okay? So if the bears are that bearish, when we're down here near the lows of the day, that shows you strong bearishness. So I can see why he would get short here, because what you have is a pullback setup for a bear trend continuation.
This bearish fair value gap, as well as this inverted fair value gap, okay? And if I just look at the 4-hour time frame, the 4-hour was trading up into this very large bearish fair value gap. Okay, so as this market was trading, into these levels, right, this becomes a very high probability trade because it's giving us such a strong indication that it's going to trade towards these lows.
Yeah, and it also closed below how many candles to the left, right? Maybe 50 candles to the left.
Okay, so as you guys can see here, I pretty much entered right around noon. I think it was 11:45. We have this 15-minute inverted fair value gap, this 15-minute inverted fair value gap, but just keep in mind all those levels that I previously pointed out in that previous chart. Okay, everything is based off of those higher time frames and my daily levels, right? So we're tracking towards these Tuesday lows. And this was a trade that I sized up on because the hourly was so aggressively trading lower and the rejection from that 4-hour fair value gap. So this is a situation where I'm sizing up into that specific trade and adjusting the stop aggressively because I have so much size on. You know, I'm not trading size and typically using a wide stop loss. I'm only trading the contract sizes that the trade allows me to put on. Okay, so some trades I'm trading 2 micros, some trades I'm trading 1 micro, some trades I'm trading 8 to 10 micros based on the way that the market's moving. Okay, so that's dynamic risk for you.
Now, that's excellent. Now, if I told you that I made $111,000 in 1 week, would you believe me if I told you that I'm trading 1 or 2 micro contracts? Probably not. Okay, so what does that tell you? That tells you that you're probably trading size way bigger than you should be.
Now I'm just going to kind of quickly run through this. So you guys can see there, I still had my 4-hour fair value gap that was plotted. And I had that 15-minute inverted fair value gap. And as we were approaching that previous day's low, I believe I exited the majority of the trade. So there you can see me, I closed 6 contracts. So I go from 8 contracts down to 2. And I don't believe I held on to the runner because it was already approaching 1 p.m. So there's the full execution. All right. So I closed that trade for $3,300 across all these accounts. So my new balance on these accounts were $187,850.
Awesome. Nice work. Okay, so we've got trade 1, 2, 3, 4. Now let's get to trade 5. The risk associated with the NFP. What is that? The non-farm payroll. It's a news report from the government. It's a number that people look at and it affects. You don't even need to know what it is. You just need to know that if there's NFP and when that's released, that's going to affect your trading, okay? And usually it's going to send the market in a direction. So trading on those days after that report is released is a very good idea.
Now, the last and final trade of the week was another bearish position that I took on NQ. The fact that we did close very close to the previous day's low, I was not expecting a TGIF setup, right? Even though we tagged out this level by just a fair margin, I was not expecting a TGIF setup. So coming into today, right, I'm sitting down and all I'm doing is going back through the previous day's levels and plotting out my fair value gap. So inside of those inside of those daily candles, I'm looking at these levels in here intraday. So here's the final execution, and today was NFP, so this is our NFP candle. And not only that, but I just wanted to protect the profits that I had from earlier in the week. So I was already up 5R from really just those 3 trades that I took. So Monday, Tuesday, and Thursday, right? I had a loss on Wednesday. I was up 5R. Today, NFP going on, Powell speaking. I was not as confident. So here you guys can see the daily candle. We were already so close to the previous day's low. This is kind of what makes it a low probability trade for me and why I only took 1 micro. All right, so I have that hourly fair value gap plotted by that red shaded level. You guys can see that. And then on the 5-minute time frame, you guys can see where I went short. I have this 5-minute inverted fair value gap here that I had my stop placed above. And it didn't take a whole lot of time to go stop me out. Okay, so I took an L on this day. And that was pretty much how I wrapped up my week. But I will walk you through how the rest of the day traded here, because if I just had my stop a little bit wider, right? So here was my 5-minute inverted fair value gap here. If my stop was just a little bit wider, and again, this is why I recommend a lot of people use hourly highs and lows as your stop loss levels and not lower time frame, because you guys can see here that it did respect the previous hourly high. Now, if I drop down to here on the lower time frame, this is what? Our previous hourly high. So if I had just used a bigger stop loss, this trade would have panned out. All right, you guys can see here that it really did, kind of turn around when I thought it was gonna.
Yeah, because what you see here is you see a trap, right? This is a sweep or a trap. You call it a lot of different things, but the high was up here, right? And then the price went up to that high, looked like it was going to break out of that high, and then got reversed back down. Okay, so if your stop loss was like here, you're getting taken out. And as soon as your stop loss gets hit and you lose that trade, the price is then reversing back down. So better to use a wider stop, which is what I've been talking about previously.
Well, it pretty much followed the bias.
Now, why? Another reason why you want to use a wide stop is because the price is in a trading range here. We went up and then we went down and then we went up and then we went down. So we're still in this range here, right? And this is what happens when you're in a range is the price will either go close to that prior high or go just beyond that prior high and then get sucked back down. And notice the same thing that happened up here happened down here. Instead of getting close to it, but not getting above it, here, we went close to it and went a little below it, and then it got sucked back to the middle. So it could be getting close, but not breaking, or it could break it past a few points. Either way, you don't know exactly where the price is going to reverse there. The only thing you need to know is that as long as we are in a trading range, the likelihood of the price either getting to that prior high or low or going a little bit past that prior high or low and then reversing and getting sucked back into the middle is higher than a breakout.
That I had, I just overmanaged it. So you guys can see here, my execution just wasn't great, right? If I had a wider stop loss, I would have been able to run this position into profit, but I really should have been using that hourly high as my stop loss. Now, that bias would have panned out, but that doesn't mean I'm holding the trade to the end of the day, okay? And as you guys saw in all those trades that I took, none of them hit full target. I'm just exiting based on time. So, keep this in mind when you're trying to trade a daily bias. If I was short here, when do I need to reevaluate my position? Ahead of lunchtime. Where does the intraday low get printed? Our intraday low gets printed when? Noon. Okay, so if I have a lower target in mind, I need to respect time of day more so than my bias, right? So you guys can see here that I took a loss of negative $262, and the ending balances for the week are $187,775.
Okay, so there you have it. He was able to take the loss and he was able to do it without losing power of his mind or emotions. So what are the key lessons here? After reviewing all 5 of these trades with this daily bias strategy, let's go through some key lessons. 1, you should stick to the bias if you're trading this strategy, because this will allow you to avoid decisions influenced by your emotions. So notice his psychological stance. He says, my daily bias is this. I'm only looking for a trade that is based on the daily bias, and I will give myself 2 tries to prove or deny that position. Great. Instead of waffling around, chasing after the price and going back and forth, he just has one thing. He tries 2 times to prove or deny it, and that's it. That keeps it nice and clean, and that will help you from avoiding emotional decision-making, and emotional decision-making is the biggest way to kill your trading profits. So you want to do things that will help you avoid those emotions sabotaging your profits. The second thing is utilizing fair value gaps and liquidity levels in identifying high probability setups. Now, he is using fair value gaps. I showed you how to use breakout points. I don't care what you use, but I just want to point out to you that I think breakout points are actually superior, because the breakout point actually shows you how to look at exactly, precisely where that reversal is possibly going to happen. The third lesson is managing risk dynamically through scaling in and adjusting stops is crucial. Now look, if you're in a trade and the trade goes your way, you want to be able to manage that risk so that you can start to take profits as the market moves in your favor. Your strategy is up to you, but that's a really good strategy. And notice he is dynamically adjusting his risk from 1, 2 micros all the way up to 7 or 8. But the key is that he's adjusting his risk. He's adjusting his position size, and he knows how to do that. He's not just blindly trading, saying, I'm going to trade this amount of risk no matter what the market is doing. He has a max, and then he knows how to move within that max. So adjust to what the market is doing and respect your rules, but then customize them and work within those risk parameters so you can go with the flow and adjust to what the market is doing. And then the last key lesson is going to be respect the time of day. Okay, because the time of day has a lot to do with what the market's doing. Now, here's your Trades by Bren Take Action Challenge. And you know, my goal with these videos is to make these videos I share with you 10 times more valuable for you so that you're 10 times more likely to take something here, apply it to your trading, and get some of this. So here is your Trades by Bren Take Action Challenge. I got 5 things for you to try out. 1, check your bias today. Open your charts and determine if the last daily candle made a higher high or a higher low, or a lower high or a lower low. Here's the question to ask yourself. Are you aligned with the market's true direction? I showed you on TradingView, right? Here's TradingView, and I showed you, look, this is a bearish daily bias. So today I'm going to be looking on the left side of my screen is the daily bias, okay? We know that this is bearish, okay? Cool. So then if we look at the 5-minute chart, then we're going to be looking for a bearish trade. So when the market gets to that exponential moving average, if we look for a bear bar closing on its low, that's a good idea because now the 5-minute chart here is aligned with the daily bias on the daily chart. Okay, so that's the kind of thinking you want to take here. Now, your second action challenge is to back test the daily bias strategy. This doesn't mean shit if you don't back test it yourself. You got to do some elbow work. You got to elbow grease. You got to do some of your own legwork in order to have this work for you. So go back 20 days on your favorite asset, whatever you want to trade, NQ, crypto, it's up to you. And track how often the next day's move, followed by the previous day's bias, had an effect. Look for patterns and journal your findings. Action number 3, use the power of 3. Before placing a trade, wait for the market to create a wick in the opposite direction first. This helps confirm manipulation before the real move happens. Action number 3. Action number 4, set a bias-based trade plan. Test this out. Identify the next key liquidity level. Look for those previous day highs or lows or the fair value gap or the breakout point, which I think is superior, and plan your trades based on where the market is most likely going to go next based on that daily bias. Just like I showed you right here with the daily chart in a bearish pattern and the 5-minute chart with that bear entry right here once we come up to test that exponential moving average and get a bear bar closing on its low, right? So now you have the daily chart lining up with the 5-minute chart, and we're doing great. Now, number 5, execute and review. Take at least 1 trade this week using this strategy, just 1, and do it on a simulator. Don't do it with your live capital because when you're testing, you want to do that on the simulator. And then once you test something on the simulator, then you bring it into the live market. Screenshot that trade, document why you took it, and review the result. And ask yourself this question: was it in line with the daily bias? And if not, what did you miss? Now, if you want more information on my strategy, go to tradesbybren.com and I will share with you a downloadable PDF for free that includes my 3 favorite trades. And I'll share with you the 3 patterns I look for. I'll share with you how I set my stop loss so I can limit my risk. And I'll also share with you how I take my profit target so I can get out before it's too late. That's tradesbybren.com or go to the link in the description. And if you're curious about the tools that I use, like this is one of them, my favorite one, TradingView. I've got the tools that I use linked up in the description as well as the prop firm that I trade with. Hit the link in the description for those. Hit like on the video if you liked it. Subscribe if you want more from me, and I'll see you in the next one. Thanks for watching.